Is the court subpoena really just about Powell? Last year, cameras were rolling as the Federal Reserve's building renovation became a political target. Accusations of misconduct were aired publicly, warnings were issued openly, and Jerome Powell found himself under pressure, not behind closed doors, but in front of the nation. Now that pressure has crossed a line. On Friday, the U.S. Department of Justice issued a formal subpoena, making Powell personally subject to a legal investigation. The case centers on the Federal Reserve's renovation project, reportedly costing around $2.5 billion. Powell responded with a recorded statement. He emphasized that the renovation is a multi-year project, conducted transparently and properly disclosed to all relevant authorities. But the most important part of his message was not about construction. It was about power. Interest rates at the Federal Reserve are not set based on presidential preferences, but on what we determine best serves the public. This was not a technical clarification. It was a historical statement. When central bank independence is questioned, the dollar is too. The investigation has drawn criticism not only from Democrats, but also from former Federal Reserve chairs, senior central bankers around the world, and prominent Republican figures. At this point, the issue is no longer Jerome Powell. The real question is this: if the independence of the Federal Reserve can be challenged openly, what does that mean for trust in the U.S. dollar? Markets are already answering. Risk appetite is shrinking. Capital is moving defensively. And once again, investors are searching for safe havens. A new tariff shock before the court even decides. While the U.S. Supreme Court has yet to rule on Donald Trump's broad tariff agenda, a new move has already arrived. Through a public statement, Trump announced an immediate 25% tariff on countries that continue to conduct trade with Iran. The countries most exposed include China, United Arab Emirates, India. This is not just a trade policy headline. It is an inflationary signal. Tariffs do not disappear. They move through supply chains, pricing structures, and eventually into consumer costs. Precious metals, no longer just a price. Story. As 2026 begins, precious metals are moving fast. Global uncertainty is shifting too quickly to allow for meaningful corrections. This environment is forcing major financial institutions to revise their forecasts upward. Citigroup now projects gold from $4,200 to $5,000 within 3 months, silver from $62 to $100. These projections reflect more than price optimism. They reflect a system under stress. Industrial metals are quietly sending the same message. The rally is not limited to precious metals. Copper, aluminum, tin, and zinc are all rising steadily. The question is no longer whether prices are moving, but why. Is this late positioning by investors chasing momentum, or is it the early stage of a structural shift in global production costs? One thing is almost certain. When input costs rise, output prices eventually follow. There is no alternative outcome. The real battlefield: critical minerals. Under the leadership of U.S. Treasury Secretary Scott Bessent, a high-level meeting was held to address supply chain security for critical minerals and rare earth elements. Participants included the United States, the European Union, Australia, Canada, France, Germany, India, Italy, Japan, Mexico, South Korea, and the United Kingdom. Together, these countries represent approximately 60% of global demand. On the other side stands China. China controls between 45 and 85% of the supply chain for many of these materials. This is not a trade dispute. It is a strategic map of future power. Why silver matters. Behind closed doors, silver has become a central topic. And the reason is simple. Silver is not just a commodity. It is a strategic material. It is essential for electric vehicles, solar energy systems, defense technologies. Last year, the United States added silver to its list of critical materials, but leaving it entirely to free market dynamics is no longer considered acceptable. CME's move. Volatility is coming. Another significant development comes from the CME. Starting January 13th, 2026, margins for gold and silver futures will be calculated based on nominal contract value. New margin requirements: gold 5%, silver 9%. In practical terms, short positions become more expensive, leverage becomes harder to sustain, forced liquidations become more likely, direction is uncertain, volatility is not. Key global data to watch. This week, January 19th to 23rd, 2026, Monday, U.S. markets closed, Martin Luther King Jr. Day. Eurozone CPI and core CPI Tuesday. Germany producer prices and ZEW survey. U.S. ADP employment Wednesday. UK CPI and PPI ECB. President Lagarde speech. U.S. housing starts. Trump public remarks. Thursday ECB meeting minutes. U.S. GDP weekly jobless claims, U.S. personal consumption data. Friday, Bank of Japan. Rate decision, ECB President Lagarde's speech.